The vaults are backlogged, the logistics are stressed, and the metal you receive might not be in the form you need. You might get 1,000-ounce institutional bars when what you need are 1-ounce retail coins. The form mismatch kills the arbitrage opportunity. Second, shipping silver internationally right now is a nightmare. Insurance costs have spiked, security concerns are high, because everyone knows silver is scarce and valuable. Customs delays are long because governments are scrutinizing precious metal shipments more closely. Freight costs have risen. By the time you factor in all those costs, the arbitrage profit disappears. And third, the real reason the gap persists, physical sellers don't want to sell. If you're sitting on silver in Tokyo and you see futures at 72, but you can sell locally at 130, you hold. You don't sell because you think the futures price is artificial. You think it's manipulated. You think it's going to catch up to the physical price eventually. And when it does, you'll make even more money. So the arbitrage doesn't happen. The gap widens. And the physical premium becomes the true price because it's what real buyers are actually paying in cash for real metal. Up until now, this premium explosion has been largely an Asian phenomenon. Western investors have been watching from the sidelines thinking it's temporary, thinking it's just regional supply issues, thinking futures prices will hold steady. But they're wrong, because the February 1st delivery crisis just proved the exchange is running out of metal. And when Western traders realize that when they understand that physical delivery is becoming impossible, they're going to do what Asian buyers already did. They're going to pay whatever it takes to secure physical metal. And that's when the premiums hit Western markets. You could walk into a coin shop on Monday afternoon and be told that American silver eagles are now selling for $125 when the spot price on your phone shows $90. You'd think it's a scam. You'd think the dealer's ripping you off, but it's not a scam. It's reality. It's the same reality Asian buyers have been living with for a month, and it's coming to the West this week. So what do you do with this information? If you're holding physical silver, the strategy is simple. Hold. Don't panic. Don't sell into the chaos. Don't let fear drive your decisions. If the two-tier market thesis is correct, if physical and paper permanently diverge, the metal you're holding is going to be worth far more than the spot price suggests. You're holding real value in a world where paper promises are failing. If you're holding paper silver, ETFs, or futures contracts, you need to make a decision. Are you willing to risk a force majeure scenario where your position gets cash settled at $80 or $90 while physical is trading at $200? If the answer is no, you need to convert. Sell your paper positions and buy physical. Yes, you'll pay a premium. Yes, it's expensive. But it's insurance against the paper market failing. If you're thinking about buying, understand what you're buying into. If you buy physical today, you're entering a market where supply is scarce, demand is high, and prices are likely to keep rising. But you're also entering a market where liquidity is low and dealer spreads are wide. Only buy if you're prepared to hold for the long term. This is not a trade. This is not a short-term speculation. This is a strategic position in a tangible asset during a time of systemic crisis. If you buy paper, futures, or ETFs, you're taking enormous risk. You're betting the exchange won't declare force majeure, that they'll navigate the March contract without breaking the system. Maybe they will, maybe they won't. But the risk is asymmetric. If they succeed, you make some money. If they fail, you lose everything. Watch the data closely over the coming days and weeks. Watch registered inventories. If they keep falling, if they hit 20 million, 10 million, 5 million ounces, force majeure becomes inevitable. Watch delivery demands. If March contract requests hit 50, 75, 100 million ounces, the system can't handle it. Watch dealer behavior. If more dealers go no bid, if spreads keep widening, if premiums keep rising, the physical market is signaling that prices are going much higher. And prepare for Monday morning. When Asian markets open, when traders in Tokyo and Shanghai see the February 1st delivery data, it's going to be volatile. Silver could gap up dramatically. Dealers could refuse to quote prices. Exchanges could implement emergency measures, halt trading, or raise margin requirements to reduce leverage. Anything can happen when a market this size faces a liquidity crisis of this magnitude. This is not a normal market move. This is a systemic crisis. The February 1st delivery data showed that demand exceeded available inventory by a margin that shouldn't be possible in a functioning exchange. Registered stock is down to 38 million ounces, an 88% decline from 2020 levels. The March contract has potential delivery demands that dwarf what's available in the vaults. JP Morgan is taking massive delivery while sitting on the largest private stockpile in history. Industrial users are panic buying because they can't source from China anymore. Physical premiums are at 80% overspot in Asian markets. In the two-tier market, paper versus physical is becoming a permanent feature of the landscape. The paper pricing system that's governed silver for decades is dying. The physical market is asserting itself as the true measure of value, and we're watching it happen in real time. The people who understood this early, who positioned for this, who accumulated and held physical through the volatility, they're going to be the winners. The people who trusted the paper market, who believed the spot price was real, who thought the exchange would always have metal available for delivery, they're going to learn a very expensive lesson about the difference between owning a contract and owning an asset. Monday morning is the moment when this story goes mainstream, when the financial media wakes up to what happened on February 1st. When analysts start running the numbers and realizing the exchange is on the brink of a crisis it may not be able to solve. The panic is going to intensify from here. Retail investors will rush to buy physical. Dealers will raise premiums even higher to reflect the true scarcity. Industrial users will scramble to secure supply for their manufacturing needs, and the exchange will face a decision that will define the future of the silver market. Do they raise the price to levels that satisfy delivery demands and incentivize holders of eligible inventory to sell? Or do they admit defeat and declare force majeure, settling contracts in cash and destroying decades of credibility in the process? Either way, the silver market will never be the same. The structure that allowed paper contracts to trade at prices disconnected from physical reality is breaking down. The supply chain that relied on Chinese refining capacity operating freely is permanently altered. And the inventory buffer that gave the exchange credibility is gone. We're entering a new era, one where physical possession matters more than contract ownership, where premiums reflect true scarcity, where strategic resource control trumps free market dynamics. Subscribe to Element Axis if you haven't already. Share this breakdown with anyone who needs to understand what's really happening, and prepare yourself. Because the greatest commodity squeeze of the 21st century isn't coming. It's here. China took control of the silver supply. The warehouse is empty. February 1st proved it beyond any doubt. And tomorrow morning, when Asia wakes up and processes this information, the world is going to realize just how serious this crisis really is. Why? Because the structural supply deficit that analysts had been warning about for years finally became impossible to ignore. Global silver demand, driven primarily by solar panel production and electric vehicle manufacturing, was exceeding global mine production by over 200 million ounces per year. That gap had to be filled from somewhere, and it was being filled from above-ground inventories, from exchange vaults, from private storage, from anywhere metal could be sourced. By the end of 2025, registered inventories had fallen to around 70 million ounces. Still a decent buffer, still functional. But then China announced the export ban, and everything went into freefall. In December 2025 alone, over 30 million ounces were withdrawn from the vaults. In the first 3 weeks of January 2026, another 25 million ounces disappeared. And by late January, we're sitting at just 38.2 million ounces. That's an 88% decline from the 2020 peak. Nearly 90% of the warehouse inventory has been drained in 6 years. And the rate isn't slowing, it's accelerating. Because the more inventory drains, the more people panic. And the more they panic, the more they demand delivery. And the more they demand delivery, the faster the inventory drains. It's a self-reinforcing feedback loop that's spiraling out of control. Now here's something most people don't realize. That 38 million ounces that's left, it's not just sitting there ready to be handed out to whoever asks. Much of it is already committed to specific delivery requests that were filed earlier. It's been claimed, it's spoken for, so the actual free, uncommitted inventory available for new delivery demands might be as low as 10 to 15 million ounces, maybe even less. There's also what's called eligible inventory, silver that meets exchange standards and is sitting in approved warehouses, but is not registered for delivery. That eligible inventory brings total holdings to around 113 million ounces, according to some estimates. But here's the catch. Eligible inventory is privately owned. It belongs to someone, and the owner has not authorized it for delivery against futures contracts. In a normal market, when prices spike, those owners would convert eligible to registered and sell at a premium. That's how the system is supposed to rebalance, but that's not happening. They're holding. Why? Because they see what's coming. They see the squeeze building. Maybe they're industrial users who need the metal for their own manufacturing. Maybe they're investors who think the price is going much higher. Or maybe they're major financial institutions sitting on massive stockpiles and they have zero intention of selling at current prices. This brings us to one of the most fascinating parts of this entire situation. JP Morgan. According to the delivery reports that just came out, JP Morgan's house account stood for massive physical delivery in January. We're talking over 1,000 contracts in a single day. Each contract represents 5,000 ounces. That's 5 million ounces of silver that JP Morgan demanded for physical delivery in one day. Not cash settlement, not rolling the position forward. Physical delivery, real metal moving from the vaults into their possession. Now, JP Morgan has been doing this for years. Industry analysts who track delivery data estimate that the bank has accumulated somewhere around 750 million ounces of physical silver since 2012. That's more than an entire year of global mine production. It's the largest private silver stockpile in history, bigger than anything the Hunt brothers ever assembled in the 1980s. And here's the part that should raise eyebrows. In 2020, JP Morgan was fined $920 million by the Department of Justice for manipulating precious metals futures markets. They admitted to spoofing, placing fake orders to move prices, manipulating the market for their own benefit over multiple years. The fine was the largest criminal penalty ever imposed for precious metals manipulation. So let me connect the dots here. JP Morgan manipulated the silver market, suppressing prices while simultaneously accumulating the largest physical position in history. They bought at artificially low prices that they themselves helped create through manipulation. They got caught, paid a fine, and now they're sitting on a stockpile worth tens of billions of dollars at current prices. And in January 2026, with inventories at crisis levels, they're still taking delivery. Over 1,000 contracts in one day. They see what's coming. They know the exchange is running out of metal. They know the March contract delivery demands are going to dwarf available supply, and they're positioning accordingly. Share this video with anyone you know who owns silver or is thinking about buying. This information needs to get out before Monday morning when markets open and the chaos really begins. Here's what makes Monday so critical. February 1st was just the first delivery notice day. The February contract is still open. More traders can demand delivery throughout the month. And then on February 27th, the March 2026 contract hits its first notice day. That's when the real pressure begins. The March contract currently has open interest that absolutely dwarfs the available registered inventory. We're potentially looking at delivery demands in the hundreds of millions of ounces against an inventory base of 38 million. If even 10% of March contract holders stand for delivery, the exchange breaks. They run out of metal. At that point, they have two options. Declare force majeure, which means admitting they cannot deliver and settling contracts in cash at whatever price they determine, or they let the spot price explode to whatever level is necessary to incentivize eligible inventory owners to convert and sell. Neither option is good. Force majeure destroys the credibility of the exchange. And a price explosion to $200, $300, or $500 per ounce bankrupts every institution that's short the market. Now let's talk about what's happening in physical markets, because this is where things get truly unprecedented. On January 1st, the same day China's export ban went into effect, a massive price divergence appeared. The futures market in New York was quoting silver at approximately $72 per ounce. That was the official spot price, the price that every financial website, every news channel, every trading platform was showing. But in Japan, physical bullion dealers were selling at $130 per ounce when they could even find inventory. Not 72, 130. That's an 80% premium over the spot price. In Dubai and the United Arab Emirates, similar premiums, $120 to $130 for physical bars and coins when the screen showed 72. This has never happened in modern commodity market history. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes trades at modest premiums in specific regional markets. But an 80% systematic decoupling between paper and physical prices across an entire region? Never. Throughout late December and early January, Shanghai premiums exceeded $8 per ounce above futures prices. Indian buyers were offering $5 premiums. South Korea saw premiums ranging from $7 to $12 depending on the product. Even in Europe, which is normally more closely tied to exchange pricing, premiums started widening to $3 to $6 over spot. What this tells us is that the global silver market has fractured. There are now two markets. The paper market, where contracts trade on exchanges at $70 to $90 per ounce, and the physical market where actual metal changes hands at $110, $120, $130 or more. And these two markets are diverging, not converging. In a normal functioning market, arbitrage would close this gap. If physical silver in Tokyo is 130 and futures are at 72, traders would buy futures contracts, take delivery, ship the metal to Tokyo, and sell at a profit. That arbitrage activity would push futures prices up and Tokyo premiums down until they meet somewhere in the middle. That's how markets are supposed to work. But it's not happening. Why? 3 reasons. First, taking delivery from the exchange is no longer easy or fast. Wait times have stretched from days to weeks. Right now, while you're reading this, something is happening in the silver market that most people won't understand until it's too late. February 1st, 2026 just passed, and the data that came out today is absolutely terrifying. The global silver supply chain didn't just crack, it shattered. And when trading floors open in Asia in a few hours, the world is going to wake up to a crisis that's been building in silence for weeks. This isn't speculation. This isn't fear-mongering. This is documented reality, and the numbers don't lie. Before we go any further, if you care about your financial future, if you want to understand what's really happening behind the scenes in commodity markets, you need to subscribe to Element Axis right now. And we break down the stories that mainstream media won't touch, the ones that actually matter to your wealth. Hit that subscribe button, because what I am about to show you is going to change how you see the entire precious metals market forever. Let's talk about what happened today. February 1st is a critical date in the futures market calendar. It's when the first delivery reports come out for the month. Traders who bought silver futures contracts and actually want the physical metal, they exercise their right to take delivery. It's a normal process that happens every single month. Contracts expire, delivery notices are filed, metal moves from warehouses to new owners. It's been working this way for decades. But this month, something went horribly wrong. The demand for physical silver delivery hit approximately 65 million ounces. That's how much metal traders wanted to take out of the warehouses. Now, here's the problem. The registered inventory, the actual silver sitting in vaults ready for immediate delivery, stood at just 38.2 million ounces. Do the math. 65 million ounces wanted, 38 million available. That's a shortfall of nearly 27 million ounces. The exchange literally cannot fulfill all the delivery requests with the metal they have on hand. Think about what that means for a second. The entire purpose of a futures exchange is to provide a mechanism where people can take delivery of physical commodities if they choose to. That's what gives the contract value. That's what makes it more than just a bet on price movements. It's supposed to be backed by real deliverable metal sitting in approved warehouses. But if the warehouse doesn't have the metal to deliver, what's the contract actually worth? It becomes nothing more than a piece of paper promising something that doesn't exist. This has never happened before in modern market history. Never. The system is designed with buffers, with safety margins, with enough inventory to handle normal delivery demands, plus unexpected spikes. But those buffers are gone. They've been drained. And today's delivery report just exposed how empty the vault really is. Now, you might be wondering how we got here. How did one of the world's most established commodity exchanges end up in a position where it can't deliver on its contracts? How did the registered inventory fall from over 300 million ounces to barely 38 million? The answer is China. On January 1st, 2026, the Chinese government implemented export controls on silver that changed everything. They didn't just put restrictions in place, they essentially locked down the global silver supply. China reclassified silver as a strategic resource, which sounds bureaucratic until you understand what it actually means. It means that silver is no longer treated as a regular commodity that can be freely traded and exported. It's now controlled by the state, subject to licensing requirements, and available only to approved entities. Here's why that matters so much. China processes between 60 and 70% of the world's refined silver, not their own production, global production. Silver mined in Mexico, Peru, Australia, Chile, it all gets shipped to China for refining because Chinese facilities are the most efficient and cost-effective in the world. Over the past 2 decades, the entire refining industry consolidated there. Chinese refineries can process ore faster and cheaper than anyone else, so naturally the market gravitated toward them. And now, with the stroke of a pen, the Chinese government has put a gatekeeper between that refined silver and the rest of the world. Only 44 companies received export licenses for 2026. Just 44. And these aren't random businesses. These are state-approved, state-controlled, or closely aligned entities. Their combined export capacity is around 121 million ounces per year. Before the export ban, China was exporting somewhere between 250 and 300 million ounces annually. That's been cut by more than half. And every ounce that stays inside Chinese borders doesn't come back out. If you're getting value from this breakdown, drop a comment below and let me know. It helps the algorithm push this information to more people who need to see it. And if this is making sense to you, hit that like button. It takes 2 seconds, and it makes a massive difference for getting this message out there. What's happening inside China right now is equally important. Chinese industrial buyers are paying massive premiums over the official market price just to get their hands on silver. We're talking about premiums of $8 to $15 per ounce above what the futures market is quoting. If the screen shows $70, buyers in Shanghai are paying $78 to $85 for immediate delivery. Why would they do that? Because they can't import anymore. The export ban cut them off from global supply, so now they're competing domestically. And that domestic competition is fierce because China is the largest manufacturer of solar panels, electric vehicles, semiconductors, smartphones, and data centers in the world. All of those products require silver. Solar panels use about 20 grams per panel. Electric vehicles use 30 to 60 grams per vehicle. Semiconductors, AI servers, 5G infrastructure, they all need silver. It's an essential input material that cannot be substituted. and Chinese manufacturers need to secure that supply or their production lines shut down. This is economic strategy at the highest level. By controlling the silver supply, China ensures their domestic industries have access to the materials they need while simultaneously denying that access to Western competitors. It's resource nationalism, and it's working. Since January 1st, Western industrial users have been scrambling. Companies like Samsung, Tesla, Apple, Nvidia, every tech manufacturer that relies on silver for production is facing supply constraints. And they're all turning to the same place, the futures exchange. If they can't import from China, they have to source from North American or European refiners. And those refiners get their deliverable metal from the exchange warehouses. That's why registered inventories are collapsing. Industrial users aren't rolling their contracts forward anymore. They're standing for delivery. They're taking the physical metal out of the system. And every ounce that leaves reduces the available supply for the next contract, creating a downward spiral that's accelerating by the day. Let's talk about the inventory numbers because they tell a story that should concern anyone paying attention. In January 2020, registered silver inventories at the exchange stood at approximately 330 million ounces. That was the peak. The system had plenty of buffer. If you wanted to take delivery, no problem. The metal was there. You filed your notice, you paid for the contract, and you got your silver. Simple. Then COVID hit in March 2020. Supply chains froze, refineries shut down, logistics collapsed. The futures market nearly broke under the strain. They came within days of declaring force majeure on gold contracts, which would have meant admitting they couldn't deliver and settling contracts in cash instead. They avoided it barely, by the skin of their teeth. But the close call changed behavior. After COVID, industrial users and institutional investors started questioning the reliability of paper contracts. They started demanding physical delivery instead of just trading price exposure. And that demand began draining the inventories. By the end of 2020, registered silver was down to around 200 million ounces. By 2021, 150 million. By 2022, 100 million. The decline was steady but manageable. The system was still functioning. There was still enough buffer to handle normal operations. Then in 2023 and 2024, something changed. The pace accelerated dramatically.